Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Hump Day. It's April 1st, Wednesday, and we got a couple items here on the economic calendar. So let's jump right on in. We got the first report of the jobs numbers we'll see for March. We'll see. We're kind of expecting some pretty bad numbers here this week. However, it's not going to show the full effect as we just kind of about almost halfway through the month is when we kind of really start feeling the dramatic effects of the coronavirus environment, of what's the impact of it into the economy. So the first report that we'll get is the ADP employment report. This is the private jobs sector. Back in February, we had 179,000 jobs created. In March, it was only 27,000. So again, even ADP warned that this is not really a full effect report because most of this data is coming in from the first half of the March. Now let's take a look at some of the manufacturing data that we're seeing out here, and we'll start off with the market manufacturing PMI. So anything 50 below 50 in these reports, these two indexes, is in contraction period. So we already started the month off in contraction at 49.2, and it dipped down to 48.5. Still a little bit better than what they expected. They're still expecting low to mid 40s. However, again, we're just in the beginning stages of all this new environment we're in. Now we got the ISM manufacturing index. We were just above our the contraction into uh, expansion area, which is 50.1 percent, but it was forecast at 44%, and it only dipped slightly down to 49.1%. Last but not least, we got construction spending. So in January, it rose month over month 1.8%. Forecast for February has gone for a 0.7% increase. However, it dipped by 1.3%. So let's jump ahead here to the headline news. Stocks are down this morning. Uh, they're really taking a look more at the toll of the U.S. and the effects of this impact of this coronavirus. They're looking at the widespread, where we got over, I think they said over 185,000 cases. We've had over 4,000 deaths. So our thoughts and prayers are out to those folks that have been impacted severely from this, not only from the death standpoint, but job losses and everything else. And a lot of people have businesses out there. There's comments by President Trump basically said over the next 2 weeks we could uh, it could be very very bad, or I forget exact details, what exact was, but in any case, it was released a new forecast for possible deaths in the U.S. Is estimated now, and projections are between 100,000 to 240,000 people may be dying from this coronavirus this year. So this is what projections aren't looking so good. So again, if you guys are out there, be safe. Keep the social distancing. It's not a joke. Hospitals are full. I know people that work in the hospitals, and most of the people in the hospitals are there due to the coronavirus. So please be safe out there. Let's take a look here, see how this affected the bond market. Bond market is down a little bit, or actually up slightly. We were down most this morning. We were down as much as like 10 basis points, but right now we're up like 2 or 3 basis points right now. Now expect this to continue down. What happened is we got propped up by the Fed by these large amounts of mortgage-backed securities, about approximately about 40 billion. We are down now. This past week, where they've been doing about roughly 20 billion. So keeping us in range, but not like making us sink, but yet kind of keeping us kind of semi afloat there, and trying to help out a little bit. So this is kind of helping out mortgage lenders out in terms of the margin calls we've been talking about. This will take time to go through, but as long as we don't see more spikes upwards, this could help us out and try to go through the pipelines that they have and hopefully get back to normal pricing and back to get some normalcy in terms of the mortgage industry. Now, of course, you may have heard a lot of programs are out there are tightening up. A lot of these things has to do with people losing jobs and having the ability to repay. We also have forbearance. A lot of people are calling for forbearance, and there's a lot of misinformation about forbearance. So if you're out there thinking of doing a forbearance, forbearance is all that really is that you're delaying your payment. It's not going to be forgiven. It's not free payment, free month, or anything like that. It's basically uh, it's going to be maybe moved off and paid later, essentially. So you pay it in one lump sum for the amount of months. Maybe let's say if you're doing a 6 month forbearance, either you pay the 6 months of payments in a lump sum, or it could be potentially spread out through the rest of the loan amount, through the rest of the remaining loan amortization there. So it will get paid. The investors want their money, but they're just working with you in terms of trying to give you a little uh, temporary reprieve, so to speak. So again, it's not, but it does also affect your credit. So because on the credit reports, if it's not reflecting the payments on that monthly base, if they can't go on there, it could affect you potentially refinancing or getting another mortgage, or potentially other bills as well. So just be cautious out to think very hard and long about doing this. If you're not in a position and you're struggling, obviously this might be a no-brainer for you. But if you're a person that has a job, you're able to make your payments, you may want to think long and hard, because we do expect this to be a long, the rates remain very low for a while here, for probably the next year or two, and we could see rates even dip a little bit further. So if you go into the forbearance, you could potentially hurt yourself from being able to take advantage of those lower rates coming ahead. So again, be cautious uh, and think hard about the forbearance if you guys elect to go that route. So right now, mortgage rates should be about the same as what we left off yesterday. We're hoping to see some improvements here. Maybe these next few days we might see a little bit more improvements as we've kind of gone through, uh, the 1 month of mortgages being refinanced and stuff like that. So hopefully we'll start seeing some improvements with conventionals and stuff. Jumbos are almost kind of gone. We don't really have a whole lot out there in terms of that. Non-QM loans, finding out that a lot of big layoffs are going on in that industry. So don't expect those to come back too soon. And your government loans, which includes FHA, VA, and USDA, those are all primarily they are tightening up on their guidelines on there. So they want lower debt to income ratios, and they also want higher FICO scores for those currently. So again, uh, make sure you work with a loan officer who is knowledgeable on what's going on there. So if you guys are looking to buy a refinance during this time, make sure you have somebody who knows help guide you through and navigate you guys through these tumultuous waters right now. All right, so um, and yields are down now, down to 0.6, so that's where we're at. We've got plenty of room, and we can even hit down here to 0.4, as you can see. All right, that's pretty much the wrap. So again, if you guys need some help in California looking to buy a refinance, please reach out. You can direct message me or email me. Email will be the quickest response. You guys have a great rest of your day. Thanks so much for watching, and we'll look forward to catching you guys in tomorrow's video. Bye-bye.